TIAA-CREF, which we'll refer to as TIA in this video, can be confusing. And if you're one of the thousands of participants in that type of plan, I want to take some time today to answer some frequently asked questions. Get the pen and paper out. Hey there, welcome back everybody. Dominique Henderson, your friendly YouTube CFP, coming at you today with some more information on TIAA-CREF. We got another video on it. I'll link it up into the cards just if you want some other information. But I wanted to take some time out today to answer some frequently asked questions like, what does TIAA-CREF or TIA even stand for? Here's a mouthful for you. Teachers Insurance Annuities Association College Retirement Equities Fund. I know they chopped it down because there was just too much to say. It's a behemoth in the place, and it does all things retirement programs, more than 5 million participants, more than 1 trillion in assets. It's actually a Fortune 100 company. Okay, so you ask, what kind or what type of retirement program is TIA? Well, it's a qualified retirement program, and all that means is it adheres to some rules set by Congress way back in, I would think, the 70s or something like that, the ERISA rules. So it does have some participation rules, some safe harbor rules, things that employers have to do in order to be, let's say, compliant for the employees that participate in the plan. All right, so what type of ways can you invest in this type of qualified plan like TIA? Well, it does have that traditional, let's call it 401k, 403b component, where you're going to pick the funds, and however the funds do will be the return that you get. That's a typical arrangement. We see this in 401ks, and you can also find that in TIA, but it's a hybrid of sorts. So if you did want to do something different, you can. What are those things that you can do different? Well, if you want to deposit sums of money, let's say you wanted to take $100 or $200 out of every paycheck and give it to TIA to invest into their annuity, then what they'll do is collect that money over time, and they will put together a program that when you retire, you'll never run out of money. You'll tell them a fixed amount that you want. Obviously, it's going to be based on the contributions you've made and the growth of that account. But the point is instead of you being in charge of the investment direction, TIA will be in charge of the investment direction, and they will pay you out an annuity however often you want that. There's different frequencies. And then the last choice would be a hybrid of both of those. So it's called a target date retirement fund. And all that means is you decide the date that you want to retire, let's call it 2050, and somewhere around 2049 or 2050, you would have the funds accumulated from that investment strategy to withdraw upon on your retirement. All right, now you may ask, can I withdraw money out of my TIA retirement fund? And the short answer is yes. However, you want to be aware that the fact that it's a qualified plan, so there are some restrictions around that. And if you withdraw your money without exception, you're going to be subject to a 10% penalty if you're under age 59 and a half, and a 20% withholding at the federal level. Usually plans like TIA will impose that 20%. Just as a safe measure to make sure you pay your taxes. Unless you have a hardship or unless you have one of those exceptions, you really want to be cognizant about withdrawing money that is supposed to be for retirement, because you're defeating the purpose. You almost impose a 30 to 40% tax on yourself once you consider the penalty and the taxes that you have to pay on the withdrawal. Is TIA a 401k or is it an annuity? Well, it's both, like I talked about earlier. It's kind of a hybrid, right? So a 401k, remember, is a defined contribution plan. So what does defined contribution plan mean? Well, it basically means that you're going to make contributions, and you can do those through salary deferrals, like you're taking 100 or 200 or more out of your paycheck, as long as you don't exceed the IRS limit for the particular tax year that we're in. And you decide what the investment's going to be. It's on you. The defined contribution, the main attribute is the fact that you as the investor pick the investments that your retirement funds are going to go into. With an annuity, it's reversed. Even though you're making contributions, the employer or whoever they outsource, whatever money manager, annuity company, insurance company, is going to make those investment choices for you. And so with that guarantee of them giving you a set stream of income when you retire, there's going to be a little bit more, risk taken on their side, and you're going to be subject to whatever the return is that they make versus 401k option. You're subject to whatever return you make. So it just depends on which one you want. Now with TIA, you actually get to do both. If you would like both options because you're not privy, or you're not, you may not think you're savvy enough to pick all the investments, or you don't want 100% of that burden on you, you can pick both the annuity option and both the 401k option. That's what's kind of cool about this particular plan, is you don't have to go all in on one or the other if you don't feel like it. So what is this annuity thing? You keep on talking about annuity, Dominique. Well, only thing you really need to know about an annuity is it's like an insurance policy. It's very much like insurance, but instead it is designed for you not to outlive your money. So you give a fixed sum or periodic sums to an investor in an insurance company that's going to invest on your behalf. And what they're going to do is guarantee that you get a set level of income for a certain duration. You may pick until you die, you may pick until you die, and then your spouse gets amount afterwards. There's all different types of ways to set the payout. But the key characteristic on annuity is so that you won't outlive your money. It's insurance, so you won't outlive your money. And a lot of people like that level of safety or guarantee. The only thing about that is in return for that safety or guarantee, you typically get lower returns. Okay, I hope that was helpful. Do me a favor, if you liked it, please leave me a thumbs up or even write me a comment down below. I would love to hear what you think. If you have any other questions, I'd love to answer those. Please consider subscribing to the community, as we would love to have you a part. Take care and bye for now.